It's well known that active fund managers struggle to compete with low-cost index funds in bull markets, but it's sometimes suggested that because they have the freedom to hold cash and bonds as well as equities, they do fare better in bear markets. So is it true?
So the evidence is unequivocal. The historical record of active funds in bull markets and bear markets is not really distinguished. In strong bull markets, active managers underperform most of the time in most equity markets in the world. In bear markets, most active funds underperformed most of the time in most equity markets across the world. However, the one qualifier I will say to that is the distinction between the potential for outperformance and the reality of outperformance. It is true, and it remains true, that there is the potential to do better by going into cash. The question is whether or not historically active managers manage to do that.
A common misconception is that to minimize the impact of stock market falls, it pays to be in an active fund. But this so-called downside protection is largely a myth.
If you are an investor who wishes to have participation or a degree of exposure to the equity market, but you are worried about downside risk and you do want to have more smoother returns over time, I'll just make the observation, you don't necessarily need an active manager to do that. There are things that an advisor can do through portfolio construction or even index funds that will achieve those goals for you, and often in a more reliable way. As an active manager actually has to have some degree of timing. They need to know when the market's going to go down in advance. And evidence tells us that's really, really hard to do.
Simply by the law of averages, there will be some active funds that do outperform in a bear market. But the number of funds that do so is consistent with random chance.
We did a study a couple of years ago looking at exactly this point, the volatility of active funds and how it compared to benchmarks. The results of that are as follows. First of all, on average, active funds tend to be a bit more risky than the benchmarks they're benchmarked against. Part of that could be to concentration, and part of that may be just because they're looking for more growth and looking to beat the benchmark. So the record is they're a bit more volatile. And when you analyze the returns, it looks like a lot of that volatility is coming from higher growth, more risky stocks.
To summarize, your chances of picking a fund in advance that will outperform in a bear market are slim. If you are worried by the prospect of falling stock prices, there are cheaper and more effective ways to manage your risk.